Hi, here we are going to look at how to account for the written down value of an inventory as a result of measuring inventory at the lower of cost and net realizable value, whichever is lower. So in the case when you have an item in store that is worth 8,000, let's use this example. This is an icon Pathfinder IAS 2 inventory. Looking at this example, component A1 in the previous example had a current value of 8,000 being its cost, but its net realizable value was estimated to be 73. The item must be written down to this amount and that and that. For a perpetual inventory system, which is also in line with QuickBooks, QuickBooks is also a perpetual inventory system because as the items are coming and going out, it's tracking, there's a record for that. We are going to debit the cost of sales and also credit the inventory. So, but how do you do that using the accounting software QuickBooks? So let's head back to QuickBooks. So we're going to create an item. I'm going to name it component A1. So we can go to list and item list. Then you right click, create a new item, then create an inventory item. Then let's name this component 1. Let's be sure. Component A1. So component A1. So I'm going to name this component A1, and the cost of goods we are going to subtract this. Let's use finished goods, or still we can still use cost of goods sold because we are selling. This is the cost of acquiring this component A1. Then the asset account is going to be inventory asset account, whichever. Since it's a component, we can still use raw materials, of course. Then from the cost of goods sold also, you can also use raw material, being component A being a raw material. Then income account can also go for sales. Okay, now let's say we have one on hand, and this one is what, according to the Pathfinder here, is worth 8,000. So let's put 8,000. So it means when we look at our inventory, click on OK, we're going to see the value as 8,000. So let's go to report. Let's go to inventory stock status by item. This is just the status. When you go to inventory valuation summary, you see we have component A1 as one on hand and the average cost is 8,000. So now let's make an adjustment because there is a fall in the value of the item. So the net realizable value is lesser than the current amount. But if, note, very important, if the current amount is less than the net realizable value, we are not making any adjustment because that is what we already have in our books of record. So there's no need for any adjustment. But now that we have a record of 8,000, whereby the net realizable value is lesser than what we have. Net realizable value is for if you are going to sell that particular kind of component A, if you are to sell it in a market that is ready for transaction and you sell, will it be up to this 8,000 or will it be lesser or more than? So, but in this case, it is lesser. So 7,300. So it means I have to adjust the current amount to 73. Then in order to do that in QuickBooks, go to vendor and inventory activities. Then you do physical. You adjust quantity value on hand. Now from quantity value on hand, we have to select the date of the transaction. So we are using 30th of December 2024 today. Then we also go to quantity. Now the adjustment type is not the quantity, or other is the total value. We want to adjust the total value. So this is what we should use, total value. Then the adjustment account is a cost of goods sold account, and the name is cost of goods sold. But then if you want to track this in QuickBooks, if you want to track it as a written down value, so let's go to cost of goods sold. This we're going to right click this and edit the account. So you can call it fallout, a fallout, or a description that will make it look like there is a fall in value, right? So let's use fallout. So I'm going to move this, so fallout. So when I click save and close, we have it here as fallout. So but then let's go back to our inventory item list, double click on this component A. Okay, we use raw material, so fine, you can go ahead. So now let's go back to adjust quantity value on hand. So now we have to select total value, then we're going to select the item. Now the item is going to be component A1. You can see here that currently the value for this item is 8,000. This is where you're going to input the current value as a result of the fair value, which is 7,300. Now once you are done with this, the adjustment is going to go for fallout. Remember, based on what we have here is cost of goods sold. But sometimes if the amount is huge, you can create an expense account to track that amount. So instead of debiting cost of goods sold account, you're going to debit an expense account, which you've already named as fallout. Now I'm going to go ahead and hit save and close. So once you save and close, we'll go ahead to check our report to see. So you can see inventory valuation summary now is 7,300. Where is the 700? How do we track this 700? Let's go to report, or go to profit or loss. So go to company and financial, then profit and loss standard. From profit and loss standard, you're going to see the fallout of 700. So it means invariably the 700 fallout is going to reduce our gross profit and eventually our net profit. But most importantly, since we use cost of goods sold, it's going to reduce our gross profit. But if you use expense account to track it, it's not going to reduce our gross profit, rather it will reduce our net income. So this is how you write down your account for a written down value as a result of net realizable value being lesser than the cost of an existing items in QuickBooks. In the next video, we are going to look out for weighted average costing, how we measure our cost for the inventory. See you guys in the next video.